Okay. On 1st January 1998, Sharma purchased a plant from Ahuja on the hire purchase system. So Sharma is the hire purchaser, Ahuja is the hire vendor. And the agreement or the deal is signed on 1st January 1998. The hire purchase rate was settled at rupees 60,000. So they've given you the hire purchase price, or they called it the hire purchase rate, which was 60,000. And how was it payable? Payable as to rupees 15,000 on 1st January 1998. First they're paying 15,000, and on which date? On the same date that they have purchased the plant. So what will this 15,000 be? If they are paying it on the same date that they are purchasing the plant, on the same date, on 1st January 1998, what will this 15,000 be? Quick. Yes, good. Down payment. And rupees 15,000 at the end of 3 successive years. And rupees 15,000 at the end of 3 successive years. What does that mean? That means at the end of, besides this 15,000, they are going to pay this 15,000 at the end of 3 successive years. So you'll have 15,000 plus 3 more 15,000, which give you a total of 60,000. That's how you get your higher purchase price. Okay. Interest was charged at 5% per annum. The asset was to be depreciated in the books of the purchaser at 10% per annum on the reducing installment method. The annuity table shows that the present value of rupee 1 for 1, 2 and 3 years are 0.9524, whatever it is, respectively. Now, first thing we need to know, we know 15,000 is the down payment. Okay, this 15,000, this at the end of 3 successive years, the 15,000 that is paid at the end of 3 successive years, is this the installment or is this the cash price? I keep asking this because this is where you need to differentiate. I've still realized there's confusion here. This 15,000 down payment is straightforward. We know that down payment doesn't have any interest. But this 15,000, is it the installment? When I say installment, that means the interest is already included. Is it the installment or is it the cash price? Is it the installment or the cash price? Audrey is saying it is the cash price. Anyone has anything else to say? 15,000 here, is it the installment? Installment means, do I put 15,000 in this column or do I put 15,000 in this column? That's my question basically. Okay, Ritika is saying installment. Audrey is saying cash price. Ritika is saying installment. Anyone else? Cash price or installment? So let's see what's the verdict based on 2 out of 3. Should 15,000? Okay, Aarti is saying cash price. Fine. It's the installment. Now, how do I know it's an installment? When will I call it the cash price? Just yesterday I was explaining it to you. When they say 15,000 at the end of 3 successive years plus interest, that time 15,000 becomes your, that time 15,000 becomes your cash price. But if they just say 15,000 at the end of 3 successive years, that is you have paid 15,000 flat at the end of 3 successive years, we are assuming that the interest is already included in that 15,000, and that's why that 15,000 becomes installment. Okay, I'll just try to take the examples of the homework problem. The third problem, the fourth problem which I have given for homework says installments of 30,000 each, and then they say interest is charged separately. So that means this installment is the 30,000 is the final installment. You will have to calculate the cash price. Whereas the fifth problem says 4,000 is the installment plus interest. 4,000 is the installment plus interest. That means their 4,000 is not the final installment. The installment will be 4,000 plus the interest. That time 4,000 will come here. Please try to learn to distinguish between these two things. You have to learn to distinguish it based on what you have read. So again, I'm just reading this. They've said, was settled at rupees 60,000 payable as 15,000 down. This is the, yes, I'm repeating again, as 15,000 down. This is how we know it's a down payment, because it's paid on the date of signing the agreement, and 15,000 at the end of 3 successive years. So when you're paying the higher vendor at the end of 3 years, you're going to only take 15,000 and give it to him. And what will that 15,000 include? That 15,000 will already include your interest. If they had said and rupees 15,000 plus interest, that time your 15,000 would have come here. You would have had to calculate the interest and your installment would have been 15,000 plus interest. Now they have not said 15,000 here, they have clearly said 15,000 straight at the end of 3 successive years. Interest was charged, that means this interest is included in this 15,000. This differentiation is made clearly in the homework problems. Problem 4 talks about a straight installment of 30,000. Problem 5 talks about 4,000 plus interest, or it said there with interest. So please get that thing right. Keep reading the problems to understand the difference. The first problem is like this, where 3,000 is the final installment. The second problem is, I'm not sure of how much is the installment, but it's installment plus interest. The second problem, which I made a video of it. Okay, so this is very important because if you consider 15,000 here, the entire thing goes wrong. So please try to understand what is given to you. Okay. Now there's something very important that's missing in this problem without which we cannot start the solution. What is that? Something very important missing in this problem. Quickly, what is missing in the problem? What is missing in the problem? We can't start the problem, we can't start the analysis of payment without that. What is not given? I saw. Mine are also coming double. It's just because of this. Okay, I send messages. Yes, that's correct. Opening balance, Aritika, yes, very good. It's a cash price that is missing. It is a cash price that is missing. Now they have told us now the cash price is missing. If you read this, the set was depreciated in the books of the purchaser at 10% per annum on the reducing installment method. The annuity table shows that the present value of rupee 1 for 1, 2 and 3 years are 9, whatever it is. Okay. And if you see the questions here, they first told you to calculate the total cash price. Now, how are we going to calculate the cash price? Now, there is a way of calculating the cash price when annuity values are given to you. Okay, so we are going to have a formula here. We are going to have a formula here. Cash price is equal to, you can learn this formula, down payment plus present value of installments. Down payment plus present value of the installments. Okay. So next question is, do we know the down payment? Do we know the down payment? How much is the down payment? How much is the down payment? Quick, how much is the down payment? I've already discussed this. Yes, 15. Very good. 15,000 is the down payment. How do we know it's a down payment? Because it's paid on the day the purchase is made. 15,000. Now the next thing is, how do we get? Now this formula can be used only when present values or the annuity values are given to you. Okay, present values or the annuity values are given to you. So how are we going to carry the present value of installment? How much is the installment? How much is the installment? 15,000 is the down payment. How much is each of the installments? Again, it is 15,000. I have already discussed this. Now, what is the meaning of present value of installments? The meaning of present value of installments is these are the present values. They clearly said that the annuity table shows that the present value of rupee 1 for 1, 2 and 3 years are 0.9524, 0.9070 and 0.8639. So what we have to do is plus, okay, what I'm going to do is 15,000 into the present value I said. So what are the present values? We've got 3 present values. 15,000 into 0.9524 plus 15,000 into, for 3 years, right? Present value of all the 3 installments, 0.9070 plus 15,000 into, is that 15,000 into 0.8639. Okay, this is how I can do it. Another shorter way I can do it is, or I can do it as, which I think most of you all will prefer. It is 15,000, which is the down payment, plus 15,000 into, instead of taking each of these and multiplying, I can total all these present values. I can total all these present values. That is 0.9524, 0.9070 plus 0.8639, and I get a value of 2. You can check this out, 2.723. I will get the same answer. Okay, so what is the basically, now I'm going to go a little into logic and sense. Okay, some of you may get more confused, but if you get confused, you just stick to this formula, but I would like to explain something to you. Now, what is this saying? What is the meaning of this annuity table is, the annuity table shows that the present value of rupee 1 for 1, 2 and 3 years are this. What is the meaning is 0.9524. Okay, the present value of rupee 1. That is, if you want to get 1 rupee after 1 year, if you want to get 1 rupee becomes the future value. If present values are this, 1 rupee becomes the future value. This is, I'm just explaining annuity tables to you. If you want to get 1 rupee after 1 year at, where is that? They did not mention it. At a certain rate of interest, that's at that 5% rate of interest, you have to invest 0.9524 today. If you invest 0.9524 today, you will get 1 rupee after 1 year. So that's a present value of 1 rupee. Similarly, present value of 1 rupee after 2 years. Present value of 1 rupee after 2 years is 0.9070. Okay, so what are we doing here? Basically, what are we doing? We know the future value. 1 is the future value, 0.9524 is the present value. Our installments are basically the future values. Why are they future values? Because we are paying them in the future. We are paying them at the end of the first year, we are paying them at the end of the second year, we are paying them at the end of the third year. Okay, and our cash price is the current value. Our cash price is the current value. So here what do we know? We know the future value. We know the future value. We don't know the current value. So we are trying to find the current value. We are trying to find the current value. So how will you get this equation? 15,000 into 0.9524 divided by 1. And this is how I got this. Why I have done this is just to explain why I have multiplied. Otherwise somebody may wonder why I am simply multiplying all this. Okay. 0.9524 is the present value of rupee 1. We want to know the present value of 15,000 because we are trying to find out the cash price. Cash price is what? Cash price is the value that you would pay today. If you pay the whole amount, the value that you pay today. 15,000 is what? When you are paying in installments at later dates. Okay. So I'm just taking one of these, 0.9524. The present value of 1 is 0.9524 today. What is the present value of 15,000? And if I cross multiply, this is what I get. Same thing you have to do for the second year as well as the third year. To avoid this multiplying each of these individually, you can also do 15,000 plus 15,000 into the total. Now this works only when annuity tables are given. This works only when annuity tables are given. Confusing? If it's confusing, forget about this. Just know this much. Okay, this is the logic behind this. Okay, like I said, I always like to give you the reason, but sometimes these reasons can confuse you further. So if it's confusing, just stick to this part. Just stick to this formula. Cash price is equal to down payment plus present value of installments. How we get it? Take your down payment plus take the installment 15,000 into this total instead of doing each one. Okay, how I got this 2.723? Put all these decimal points together. Okay, so this is going to give me 15,000 plus 15 into 2.73. The total, I am directly doing the total. It's 55,845. 55,845. So basically this is my cash price. This is going to be my cash price. I'll just put this in italics just because it's like an explanation for this. Okay. So this is what we have to find out. Now we can start our analysis of payment because we know our cash price. Now this is possible, this calculation is required only when annuity values are given. So in this problem, cash price is missing. Then the next problem that I'm going to do, which I'm going to make a video of it, the installment will be missing and you'll have to find out the installment through annuity values. I'll show that in the video. It's the same formula, you just have to rearrange it because that time the installment is missing. Okay, that time the installment is missing. Is that clear? Okay, so this is the way you have to find out your cash price. So, any questions? Anyone wants to ask me anything with regard to this calculation? So, the first part of the problem is calculate the total cash price which we have already got. Okay, I'm making a recording of this lecture anyway. So, if you want, you can. I will send the recording. You can go through that full explanation again. So, let's start now. First thing that we need to start is on 1st January 1998. On 1st January 1998, so we have on 1st January 1998. Opening balance of cash price, we know it is 55,845. Okay, here we are doing the down payment. How much is the down payment?
Miss,
Yes,
ma'am, I have a question.
yeah, tell me.
Miss, what about that 60,000 which was given in the
Ah,
question? What should we use it
60,000.
for?
They've said this is a higher purchase rate. We don't use 60,000 anywhere, right? Do we ever start anything with 60,000? And then what they're giving you, they're just giving you a breakup of that 60,000. What they've said, the higher purchase rate is 60,000. Higher purchase rate is always higher than the cash rate. Why? Because it's inclusive of interest. So this higher purchase rate is paid as 15,000 as down payment and then 15,000 in 3 successive years. So 15 plus 15, 30 plus the second installment 45 plus the third installment another 15 which makes it 60. Cash higher purchase price we don't use anywhere except finally when we get this total. Finally, when we get this total of this installment column, here we will surely get 60,000. We can check it later. Okay, you get the total of the cash price, which is the cash price. You get the total of the interest. This plus this will surely give you 60. Okay, we can check it out later. Did I answer your question, Audrey?
Yes, Miss,
Okay.
thank you.
Yeah. So interest, we never have interest on the down payment. So the interest is always blank. So the installment will be 15,000. Closing balance will be opening balance minus cash price paid. It's the same thing. So 55,845 minus 15,000 gives me 40,845. We don't need to calculate depreciation because we are at the beginning of the year. Okay. So next, so there's no depreciation because it's at the right at the beginning. So the next is now they are paying yearly installments. How we know it's yearly? And rupees 50,000 at the end of 3 successive years. So they are not paying quarterly or they are not paying in the middle of the year, half yearly. It's at the end of the year. So the end of the year will be 31st December 1993. Opening balance is 4845. Okay. Now, like I said, I've kept repeating this. We don't 15,000 that we know is the installment. Okay, 15,000 that we know is the installment. We will have to first calculate the interest. We will have to first calculate the interest. How I'm going to get the interest? 4845 into what's the rate of interest? Rate of interest is 5% per annum into 5% per annum into full year 12 by 12. So we don't need to do that. It's understood. Okay. So 4845 into 5% gives me 204. Somebody's doing the problem along with me. I hope you all are also using your calculators and checking. 2042. And my cash price will be installment minus the interest, which is going to be 12 958. Okay, closing balance of cash price will be 4845 minus 12958, which is going to be 27887. 27887. Now we can also calculate depreciation. See, depreciation again I am repeating it. Depreciation is not necessary that you calculate it here. You can either do it as a column here or you can directly do it in your asset account. Directly calculate depreciation. It's not compulsory that you do it here. Okay, sometimes I may do it here, sometimes I may not do. See what you're comfortable with. See where some of you may prefer doing it here, some of you may prefer directly showing depreciation only here. Okay, now since I put the column, I'll show depreciation. Now depreciation, how is depreciation going to be calculated? It's going to be, what's a cash price? Depreciation is always calculated on cash price. Okay, 55,845 into the percentage of depreciation. The percentage is 10% per annum. 10% per annum. We have used the machine for the whatever asset it is. We have used it for the full year, 1st January to 31st December. So there's no need of period. It will be 12 by 12, and the amount of depreciation that you get is 55,845 into 10% will give you, after rounding up, will give you 5585. How did I get this? If you say 10%, 5584.5, so 0.5 becomes 5585. Okay. Coming to the next installment, 31st December 1990. Sorry. Thank you, Kimberly. 1999. Thank you, Kimberly. Bring down the balance. See, depreciation doesn't affect any of these things. So please never add or minus. Don't do anything of that sort. Bring down the balance. 27,887. Okay. Cash price we don't know. We will have to calculate. We know the installment. Do the same calculation here. So instead of 4845, we have 27,887 into 5%, and that is going to give me a figure of 1394. 1394. So 15,000 minus 1394 is going to give me 13,606. And here what I'm going to get, 27,887 minus 13,606, it's going to give me 14,281. Okay. Now be a little careful, okay? That's why sometimes I feel depreciation is easier to calculate here. Now what you have to do, we are following the written down value method, reducing installment. The set was to be depreciated in the books of the purchaser at 10% per annum on the reducing installment method. Now what is this reducing installment method? It's also called written down value method, okay, or diminishing balance method. I think you have studied depreciation in the past. Now what happens here is, when you're calculating, say for example, you're calculating depreciation on this date, that's the end of the second year, you have to minus the previous year's depreciation from the original cost, and on the balance you need to calculate the depreciation. Okay, so how are we going to do that? What is the original cost? 55,845. 55,845 minus, what's the previous year's depreciation? 5585 is equal to, you get I think 50,260. Okay, you get 50,260, and on that you calculate 10%. And on that you calculate 10%. So that is why it's called the reducing balance method, because every year you don't calculate it on the original cost, but you calculate it on the reducing balance. What's that reduced balance? Minusing the previous year's depreciation. So 55,845 minus 5585 gives you 5260. 10% of that gives you 50. 52, 16 to 10%. Remove 1 0, you get 5, 0, 2, 6. I think you've done this method of depreciation before. Okay. So that's how you calculate the depreciation. Next year, how are we going to calculate? This year's balance is 5260. 5260 minus 5026 and whatever balance remains. Okay, that we'll see in the last year. So we come down to the last year, 31st December 2000. Bring down the balance 14281. Our installment is 15,000. Now, like I said, we need this nil because it's a last year. We don't have to pay anything further. Okay, we need this as nil. So 14281. I'm going to write the same thing here, and this is going to be my balancing figure. So 15,000 minus 14281 is going to be 719. Okay, how I'm going to get a depreciation now? How am I going to get the depreciation now? Right now the balance of the machinery is 50,260. Okay, so 50,260 minus this. Copy the same thing here. 50,260 minus the previous year's depreciation. Previous year's is 5026. 5026, and that gives you 45,234. 45,234. So the depreciation here will be 4523. 4523. I'll show a simpler way of calculating depreciation instead of doing this here. I'll show you a simpler way of doing it in the account itself. Then you all check which one you all prefer. I feel it's easier to do it in the account. Okay, I feel it's easier to do it, but you all check what you all prefer and then do it accordingly. Okay, so now we need to total this. If you total this one, you're going to get 55,845. You can total and check. If you total this, you're going to get 4155, and if you total this 15, 15, 15, 15. Audrey, this is the only place we write the higher purchase price. Okay, you can check this total. This plus this has to be equal to this, because that's how you get your higher purchase price. Cash price plus the interest, and that's why a higher purchase price is always more than the cash price. Any questions? Any questions with regard to this? Okay, so let's go proceed with our entries. So we are doing in whose books have they asked us? Always check that. Show the ledger accounts in the books of Sharma. Now who is Sharma? Sharma purchase. So Sharma is a higher purchaser. So in the books of Sharma, which are the books that we open in the books of the higher purchaser? First is the asset account. Yeah, it's called a plant. So we call it plant account. Plant account. Then we have the hire vendor, name of the hire vendor, Sharma purchase from Ahuja. So we have Ahuja's account, and finally the interest. They've not asked for a balance sheet in this part. Interest account. Okay, so let's start posting. First entry is record the purchase. So how is the purchase recorded? Asset account debit to hire vendors account. So plant account debit to hire vendors Ahuja. So on 1st January 1998, got the date correct. Plant account debit to Ahuja. Cash price always 55,845. And in Ahuja's account, you will have 1st January 1998 by plant 55,845. So we have recorded the purchase. The next thing is make the payment, make the down payment. Now in the problem that I solved yesterday, we didn't have the down payment. If the down payment is not there, the entry won't be there. If it's there, you pass the entry. What's the entry for down payment? Higher vendor's account debit to bank. So here we have 1st January 1998. Down payment always happens at the beginning when the agreement is signed. It cannot happen at the end. That's why it's called down payment. You make the payment when you take the possession or take the asset. So to bank, down payment is 15,000. Okay. Now we go to our sequence. So we start with the interest due. What's the entry? Interest account debit to Ahuja's account. So in Ahuja, you will have 31st December 1998 by interest. Interest of the first year is 2042. 2042. Similarly, in interest account, it will be 31st December 1998 to Abuja 2042. Okay. So after showing the interest due, next is payment of the installment. Ahuja's account debit to bank. The first bank is the down payment. The second one is the installment. Don't get confused. Installment is 15, right? It's always by the installment, never by the cash price. Always the installment because we are paying the interest and the cash price. So finally, whatever is paid. Okay. And now then we also have, since we have depreciation, we also need to show depreciation. So depreciation will be depreciation account debit to asset account. So depreciation to plant. So in plant account it will be by depreciation. Okay. Now what I was saying here, say suppose some of you had not done this. Say suppose some of you had not done this. How would you have calculated depreciation? Basically on the balance that is there. So 55,845 into 10%. Okay. So some of you find it easier, you can do it here itself, or if you find this better, it's up to you. This is not compulsory here. It is not compulsory at all. You don't need to show this here. So you all choose what you want to do. Anyway, we have already calculated depreciation. It's 5585. How did I say you can get it? Look at your balance here and multiply it by 10%. What happened, Michelle? The interest of last year? You mean the transfer to the P&L account? Are you talking about that? Michelle, what are you talking about? You're getting 714. How are you getting 714? 15,000 minus 281. Okay, Muriel, Michelle, till here you are getting the same thing. What did I tell you of in the last year? If you remember, what did I say? The interest is the balancing figure. You remember that? We don't. No. That's what I told you. See what happens if you multiply. Look, okay, good. You brought it up again. Maybe some of you may have confused. See what happens if you calculated. Like, please, everyone, listen here. What happens if you calculated? Take 14,281 into 5%. Like you said, you get 714. So if I do, say, suppose I had written this as 714. Okay, say suppose I had written this as 714. 15,000 minus 714 would have given me, I think, 6. Okay, 286. Okay, just say I'm getting 14,000. Now what happens is this and this don't balance, and then I will still have some few rupees left here, which I don't want because it's the end of the agreement. You remember I told you this? So in the last year, this has to be 719. How I know it's 719? You write this first. You write this first, 14281. This becomes the balancing figure. How I'm going to get that? It's going to be 15,000. I've done this right from the first problem onwards. This is how you're going to get this. Okay, remember this, please everyone remember this, otherwise you will get confused. Okay, anyway, good you brought it up. It may be a recollection for some others as well. Fine. Okay, so now we have shown the depreciation. Next thing we have to close. So first close the interest account. So when you close the interest account, the balance is transferred to profit and loss by P and L account 2042. 2042. Close this. You will have it. You'll have it here. The total here is it is 55, 57, 887. 57,887. Here also we have 57,887. Okay. So on 31st December 1998, you have two balance carried down. How much is the balancing figure? You'll have it as 27,887. Okay. Always please remember, before going ahead, bring down the balance. Otherwise, there is a possibility that you may forget. 1999. By balance brought down, you get 27,887. Okay. Close the plant account. Here you will have the same date, 31st December 1998. By balance carried down, the total is 55,845. 55,845. Balance carried down will be 50,260. Bring down the balance before you start the next year. First January 1999 to balance brought down 50,260. Okay. So let's start the second now. Second year, we don't have to record the purchase and the down payment. We directly start with the interest. Okay, so interest will be interest account debit to hire vendor or interest account debit to Ahuja. So it will have here 31st December 1999 by interest. Interest for the second year is 1394. 1394. Similarly, in the interest account, post the same thing. Amount of interest is 1394. Once the interest is posted, make the payment of the installment 31st December 1998 to bank. Our installment is the same, 15,000. Okay, and finally pass the entry for depreciation. So 31st. Okay. Now look at depreciation. Say suppose you had not done all this calculation. Now we had to do to calculate the depreciation for the second year. What we had to do? We had to take the original price minus the previous year's depreciation, get this, and then into 10%. Now if you don't do this and you directly do it here, see, based directly on this amount that you get, which you already calculated, you can directly calculate depreciation. So 50,260 into 10% is going to give me 5026. Especially for the written down value method, this works well. Okay, you don't waste time here finding the written down value every year. So this works well this works well for the written down value. So if you want, you can skip this and directly do the calculation here. On the opening balance, what is this opening balance? You have minus the previous year's depreciation, and that's what you have got. Okay, so see what you prefer. Like I said, this is not compulsory. Some problems I've done it, some problems I've not done, because some of you may be comfortable, some of you may not be comfortable. Okay, there is no hard and fast rule. See what you're comfortable with. So next is closing. By P&L account, we have 1394. So we are done closing this account. Close the next one. The total here is 27,887 plus 1394 gives 29,281. 29,281. Here also 29,281. 31st December 1998. 2 balance carried down. 29,281 minus 15,000 gives me 14,281. 14,281. Bring down the balance immediately. 1st January 2000. By balance brought down 14,281. I forgot to do that checking that we normally do. See, by balance brought down for the second year is 27,887. Let's just check our table. Yes. And for the third year is 14,281. Okay, it's the same. And close the depreciation account as well, the asset account. Sorry, this is 99. This is also 99. By balance carry down, get the total here. 50,260. 50,260. Balancing figure will be 50,260 minus 5026. We get 45,234. 45,234. Bring down the balance immediately. 1st January 2000. 2 balance brought down. 45, 234. Okay, and we proceed to the last year. So the interest first. So 31st December 31st December 2000. By interest, how much is the interest? 719. Interest is 719. So if you're showing interest in Ahuja's account, in interest account, you'll have 2 Ahuja, 719. When I put this underline here, I mean it's closing. Okay, I told you this in the first prop. You don't have to keep putting it again. Just underline it there itself. Next, pay the installment. 31st December 2000 to bank. Final installment 15,000. Show the depreciation. 31st December 2000. Again, like I'm showing the depreciation. Now, if I had not done this, I would have directly got this 45,234 and I just take 10% of it instead of doing this calculation here. Okay, like I said, written down value method, it becomes easier to directly do the depreciation. So, by depreciation, 45,234 into 10%, 452, and then close the books. So here you'll have transfer the interest to the P&L account 719. This will automatically tally, like I said, 14,281 plus 719 is 15,000. This side also your balance is 15,000. This you'll have a balance carried on because the machinery is still existing. Okay, so the balance will be 45,234. You have 45,234 Balance carried down here is 4711. 4711. So this is how the problem looks. So the only thing different that we did in this, the only different thing that we did in this question is the annuity values. Okay, so the annuity values were different. Otherwise, the rest of the problem is all the same, and I'm glad some of you are solving and had that doubt about the 714, because I know I've already clarified it, but it's good to keep asking certain questions again for the benefit of everyone. Any questions with regard to this specifically? Any questions? Please do the homework. Those who have not done the homework, please do the homework. You can do it over the weekend, because if you don't do the homework, you don't get practice. Okay, because I know some of you are not solving along with me, you are just watching. It would be nice if you could solve. It would be really nice if you could find a way of solving along with me, because it will be much easier for you. Is that clear? Any questions? Any questions? Any questions?